Hey, everybody. Welcome to This Week in Pre-IPO Stocks podcast, first pod of 2024. With me, I got Nick Fusco, CEO of 8View, a pre-IPO secondary market pricing company, and Clint Sorensen, Chief Investment Officer at WellShield, an outsourced CIO and investment research company. Okay, 3 topics today. First one's Carta. Okay, so if you're on Twitter, you're on LinkedIn, you're like seeing this thing evolve in real time. This is what's going on. So Carta does cap table management for a lot of companies out of Silicon Valley, a lot of startup companies, right? They have, and they've also recently started like a secondary market brokerage business that trades secondary stocks, right? So they had one of their clients, one of Carta's clients, this fellow, Kerri Saarinen, and I probably pronounced his name wrong. He's the CEO of a firm called Linear, right? He came out on Twitter this past week and said that Carta's secondary brokers were calling his shareholders on his cap table, right, which is technically private data that's within the Carta cap table division, and pitching them to sell their shares in the secondary market. So he was the CEO. This fellow Kerri was not happy with this, and he kind of said as much on Twitter, on X. And subsequently, like a lot of people piled on. Same thing's happening to me. I'm not like they shouldn't be doing that. So all this stuff. The CEO of Carta is responding, right? And it's a very interesting dynamic. So, fellas, what are your thoughts, right? So I know, Nick, you deal with a lot of these brokers, so I understand if this might be a little bit of a sensitive topic for you, right? But maybe I'll start with you. Like, what are your thoughts around this particular scenario, right, with Carta and kind of their cap table and their brokerage business? Like, are they in the wrong here? Should they have thought about this a little differently? Like, what do you think?
I think in this incident, it's a clear wrong, right? I mean, the CEO of Carta did fire back or didn't fire back, came back and put a bunch of prayer hands in his response saying, okay, this was a one-off, we made a mistake. And then I think a whole bunch of people fired back coming in and saying, oh, if this was a one-off, why did it also happen to me? Why did it also happen to John and Mary and so on? So, yeah, I think it's quite the hot button to use that information to your advantage. And the broker community of those that we work with are seeing this as an opportunity, right? Because they are very much acting as independent. They go about it as traditional sources to figure out maybe who is potentially on the cap table and working with them and accessing them. And in this case, I think Carta, maybe the folks that overstepped from the X side or the brokerage division got to maybe play God a little bit too much, right?
Yeah.
I think that conflict of interest could be known when you're signing up to use Carta for cap table. We as a company purposely chose, knowing that we're going to be active in this space just generally in the ecosystem. We decided not to use Carta initially. We used Figure. We moved from Figure over to Pulley more recently and just found it was more robust as an offering. And they don't do neither is a brokerage. I know
clean.
that you have Morgan Stanley. They have ShareWorks. Fidelity has ShubyX. There are a lot of other options out there. And to my knowledge, none of the other options are trying to play both sides.
Right.
So I didn't like the feel of this. I think the response was totally justified from Kerri. And actually, Carta X has been around for a number of years and has sat relatively dormant from our view, looking at the brokers in the community, and they were not and have not been a big player. But this could have been a way to get involved. But I do think that would be overstepping their bounds if they did so or continue to proceed down that channel.
Yes. So what do you think, Clint? Overstepping a little bit, or what's your thoughts?
To quote Dave Chappelle, they're a perpetual line stepper. Actually, that was Charlie Murphy in the Chappelle Show, the Rick James episode. But yeah, I mean, that's a perpetual line step, right? If you did it 3 times and you've been called out 3 different times by 3 different clients by using confidential information to give yourself an edge, I think that's definitely a misstep.
Yeah. So what do you guys think about? So like, look, just what do you think in general? I think there's just at times perhaps a CEO of a startup company has this kind of negative perception on secondary sales, right? On secondary transactions happening. So, like, Clint, what do you think? I mean, if you're a CEO of a startup company, do you like this stuff? Do you not like this stuff? Like, and if you know what
Yeah, I
and
mean,
why would you like it or not like it?
yeah, I mean, I like it for liquidity purposes, right? You got to be able to provide liquidity in the liquidity environment. Although we get conditioned like Pavlov's dogs to think it's always going to be positive, we've awakened to the reality that there's a couple years where it hasn't been so positive, right? You
Right.
can't exactly access markets as easy as you'd like, and you've got to incentivize talent to do what they're doing, right? If you're going to attract top tier talent, keep top tier talent, everyone's wearing the "We Work for Equity" T-shirt, and if you can't provide them liquidity for that equity to help them with their expenses rising or what have you, or lifestyle changes, et cetera, you're going to miss out on keeping long-term talent. And so I think you're only as good as the people you attract and maintain and retain as an organization. So I like it from that purpose only. I don't see why you wouldn't like it. But again, I'm not in their shoes, and so I can see
Right.
in some instances having the pricing pressures and um, having the quote unquote vultures flying around,
Right.
right, trying to
Right.
creep
Right.
in. You got
Right.
to have
Right.
it's a lot of headache from a governance perspective to make sure that these types of transactions go on smoothly and don't provide a lot of distraction and et cetera, et
Yeah.
cetera. But being all that being kind of done for you, I don't see an issue why you wouldn't do it.
Yeah.
I
Okay.
think if
So
you're able to manage your cap table really, really soundly, and you're thoughtful about the approach, it's going to serve a long-term benefit, right? So if founders are more capable to provide liquidity facilities each year on a recurring basis, you know what?
right.
It's going to dry up the secondary activity, and you hold the cards as to where those transactions are going to take place.
Yeah.
And then you also have better liquidity and probably better, more accurate pricing for those events.
Right.
So I really think, yeah, it's in the best interest for the founders to be really, really thoughtful about that as the company grows. Because if you're not doing it early, as the company grows, it's going to get a little bit out of hand, and all these transactions are going to start happening, and eventually they're going to get so big that you can't start to ROFR, or
Yeah.
conditions are going to pull back, and you don't have the money to do the ROFRs,
Yeah. Right.
or at a particular size, everything starts to get SPV'd up, and then you have no control over what's actually occurring.
Yeah. Because it's
So,
happening away from you.
so,
Yep.
so yeah, I think that's why some of these cap table management tools are so important. And then to trust in your provider that they're going to do what they say on the tin is kind of paramount, right? The integrity of the solution or that you think you're getting is really at question here, and that's why people are firing off, right? It's just
Yeah.
like
So
us internally. We commit. We will never be participating in a transaction at EQ.
right.
We work with a consortium of brokers. They are effectively our bread and butter for the partnership. We don't want to get in the way of that. That's a great
Yeah.
and trusted relationship that we want to promote for decades to come.
Right.
And I think that's the concern of what trust got broken here.
Okay.
Right?
But let me ask you. So this isn't like a new. To me, I read this and I was like, it happens all the time. But like this stuff, this idea of this like conflict of interest. Like I worked at Morgan Stanley. We had people, one division doing one thing, another division doing another thing, same client, different opinions. I mean, Goldman, this is like the stuff back in like 2008 where Goldman was like out there doing investment banking work for a company, and then the asset management division or the prop desk is like selling the company short, right? So they're like selling it, telling people how great this company is and how you should invest into it. And then their other division at Goldman is selling it short. It's like a Chinese wall. It's literally the definition of a Chinese wall between divisions, right? So I mean, this clearly, if they had a clear Chinese wall, I don't think anyone would have a problem with it. Is that fair? I just think it's this idea that they use the data this way is what's getting people a little fired up. You think that's fair, Clint?
Yeah, that's what it was, right? I mean, that's why you have the Chinese wall. That's why it's recommended. That's why there's all the conflicts of interest that you've got to disclose if you're an investment bank and you have other divisions, right? You've got prop trading desk, or you've got, co-owned hedge funds. I mean, look, it's hard to avoid all conflicts when you have a large institution and you've got multiple business units. I think the key is adequate disclosure and being upfront to the client about everything. both verbally and in written. I'm not talking about footnote or like what the pharmaceutical companies do, where they read off real fast all the side effects on the ads. I'm saying like proper disclosure, like telling the client, like, hey, do you mind getting consent? Hey, do you mind if we use this data in another division? And having them sign off on it or click the box. I think that's ultimately the direction you have to go to use it. Again, ethical judgments are a matter of perspective in this instance. I think a good business practice is just to be honorable to your client and gain their consent before you use their data that they've entrusted you with.
Yeah.
So Nick, hold on. I just want to get your point on that. So like so to that point, right? I do think there's a way that you can have a business, like Carta could have a business that could actually benefit use that data, use the cap table data, but actually benefit the startup. So like they could start their own venture capital fund, a Carta Venture Capital Fund, raise capital from people and then invest into businesses that are on their cap table. And they could, I mean, I got to tell you, as an investment thesis, that's super interesting to me. They have like insight into all of these companies and data that nobody else has, right? And they can use that to like place bets in their fund. That's interesting. I also think that the companies, that'd be like, that's great. You're going to write a check and invest into my company. That's an awesome thing, right? Same thing for debt. They could, I think, do lending. They could probably have really interesting insight on where people are and in their spectrum. I mean, like Nick, like, do you think that's probably businesses that Carta could start that wouldn't be, I think that could use the data and be a competitive advantage for Carta, but I think be more in line and beneficial to their cap table customers, right?
Absolutely. And I think there's another angle. So what you described is not terribly far off to what AngelList have. They have funds. You can invest in a lot of companies that are promoted on AngelList. But at the same time, what I was hitting on before was if you were planning as a founder to have a continuous or annual liquidation event and you want to control that, hey, guess what? There's probably no better company to do it than a Carta, right? But you then go to them and say, hey, can you help me activate XYZ portion of my contract so that I could manage this and you guys are going to get X number of basis points out of it. But in this case, it's Carta potentially or suggestedly coming in and doing it willy-nilly whenever they want, right?
Yes.
Like, let's get some shares to sell.
That doesn't work.
So I think if it was programmatically triggered by the executives or the board of the company, great. You know what? Carta's in a clear market-winning position to do that. But when they take the matters into their own hands to act on it without the consent immediately, or maybe it's embedded somewhere in those contracts, as Clint's kind of hitting on, that's maybe more profitable and maybe more aggressive, but not the right way to go about a business in a long term. In my humble opinion on that.
It's going to be interesting to see what happens here. I mean, there was a really cool write-up on X where this fellow was talking about, Carta driving revenue and building into their valuation, and how like this cap table management business just isn't big enough. Like the TAM isn't big enough to be able to build into their kind of valuation that they're at. So they have to find these other business lines to drive revenue. So it's going to be interesting to see, one, if they're going to be able to, like, Carta is going to be able to navigate the storm and get through this without losing, a healthy amount of cap table customers, but also too, like, what other businesses, ancillary businesses, are going to be able to start to try to work into that valuation.
I saw that comment too, and it made me really start to think, I wonder what Carta's cap table looks like.
Yeah, the cap table.
Because I'm starting to question what those common shares are actually worth relative to the preferreds on that.
You should call Carta's secondary team and see if you can buy some Carta shares.
There you go.
Yeah, I'm actually seeing. All right, so Carta is down, utilizing APU data, change year over year from 2022 to the end of 2023, down 19%. That is as of year end. So I'm also pretty interested to see how that's going to shape out over the next month, because you could very, very quickly see a 19% loss in a month.
Oh yeah,
I believe that.
Private markets. Yeah, I believe that. Okay. So let's switch gears. So this is the first pod of 2024, which is an awesome opportunity to kind of reflect back on 2023. And there's this incredible secondary market pricing company called ApeView Okay. And they publish
Got
their
it.
numbers for the year. So now we can really look at this, right, Nick? So all right, guys. So I'll put these up in kind of post-production. I'll put up the diagrams here that I emailed over to you guys earlier today. But the AI companies really didn't kind of come online in a proper way in the secondary market until really the middle of the year. So when you look at kind of the top 10 companies and who's on top, you got Scale.AI and Databricks showed up big. Scale.AI was up 93%. Databricks was up 42%. SpaceX was up 22%. Anduril had a good year at 18%. Chainalysis kind of bucked the trend of blockchain and posted 15% up this year, which is great. And then Deel is kind of another notable, in there at a 10% gain for the year. I love that company. But number 10 on the list, Rippling, negative 1%. Right. So this is the little group of stocks that I track 30 stocks in kind of like my research universe. Right. So this is what I focus this little analysis on. But it's a little telling that your number 10 best performer for pre-IPO stocks had negative performance for the year. Right. When NASDAQ was up 55%. But on the downside, Flexport's down 60, Plaid was down 53. Right. It was rough. Right. It was kind of a rough year. But then I also threw in there the 6-month returns. Right. So that's where you started to get some of the AI companies. So Anthropic had a 302% return, 155% over 6 months for OpenAI. Plaid was up 40%. So Plaid was down 53% for the year, but it was up 40% in the second half of the year. So you can imagine what that looked like. Right. So, just interesting thoughts. So like, Nick, maybe I'll start with you. Like, what are your thoughts just kind of on returns in pre-IPO stocks on a macro level and any companies that kind of jump out at you, right, on this list?
Yeah. So the last or penultimate page of this report touches on the Magnificent Seven. So your Meta, NVIDIA, et cetera. I love seeing this chart breakdown because it's showing where the top 7 companies that really drove the public indices performed relative to the 850. Then we flip it and we show the Magnificent Seven performance relative to 7 of the top sized companies within APU in terms of depth. And you've got Databricks, SpaceX, Anduril, Klarna, ByteDance, Stripe, and Consensus again. And I feel as though, a lot of the time on this pod, I brought up how NVIDIA, Meta, and Google, Amazon, and Microsoft are all just killing it because they have so much of the compute and so much of the ecosystem for data, and they're going to continue to perform. And that's my infrastructure play. But if I had to guess for 2024, I'm really thinking any of these 7 or hopefully more than half of these 7 that are in the private, we need to make a name for it, right? That's got to start outperforming some of these big NASDAQ names. So even if we did the S&P 500 minus the 7 or something like that, I think you're going to start to see some catch up, because in a lot of ways the private market has lagged the public in 2023.
Big time.
And I think the catch up and the beta on these is really going to blast off in 2024. And I'm not a perpetual optimist, but I think it's coming.
Right. So Clint, you're living in both these public and private markets, right? So I mean, NASDAQ crushed this year. S&P had a great year too. But to Nick's point, like the private markets are lagging. So like, what do you think? What do you think is the driver of that?
You got to put your cycle hat back. Yeah, you got to put your cycle hat on, right? So, and I'm not talking about like motorcycle hat. I'm talking about like your business cycle hat. And if you think about the end of the easy cycle, the accommodative Fed policy, all that ended in 2021, right? The Fed started hinting at rate hikes in 2022, started hiking rates in 2022. Liquidity trends completely changed. So if you mark the top of the cycle in 2021, which by valuations, by many other measures, it's hard to argue that was the peak of the most recent cycle. When you mark that point, cash has outperformed the NASDAQ and the S&P since then. So what does that tell you? Just in the public market speak, that tells you there's a liquidity preference, which is typical for that part of the cycle. When your liquidity is contracting, M2 declining year over year for the first time since 1929, right? Or 1932 rather. When you have when you have leading indicators down for 20 consecutive months, looking at conference board, negative year over year, 20 consecutive months, when you have ISM below 50, all these things are just telling you for 14 consecutive months. All this is telling you that the liquidity trend, the cycle trend was in a decline, was decelerating. Doesn't mean there's a recession or has to be a hard landing or all this narrative nonsense. All it tells you is that very clearly the data is decelerating. And in that decelerating trend, there's a liquidity preference. So it makes complete sense why public companies would outperform private companies due to liquidity preference. And that liquidity preference, I want things that I'm able to sell. And in particular, those mega seven, which the Magnificent Seven, which I saw in an Apollo report, which is fascinating. You can find the chart, put it in the printout. If you need it, I'll send it to you. But the Magnificent Seven names are actually larger in market cap than the equity markets of Japan and the UK and one other market combined. Think about that.
That's wild.
France or something, yeah.
Pretty wild, right? So yeah, liquidity preference in the biggest names with the most liquidity that hold down the indexes, that can get you can get easy exposure to very quickly. Make a lot of sense why they would dominate in a slowing growth phase. But now we've got POW Pivot 2.0. We've got global central banks starting to ease off the brakes, right? And not only the brakes, I'm talking a parking brake. And now you've got the Fed talking. You went from rate hike expectations in 2024 to 6 rate cut expectations in 2024. And I'm not sure we're going to get there. Who knows? But what I'm saying is that this trend is changing. And so what it does is it allows duration to come back into play. And you've seen that with the disinflationary trend of growth and inflation slowing. And guess what? High beta starts running. Small caps start running. Well, I want small caps too. And even though they're not small capitalization companies, I want venture. I want venture with lockups. I want long duration, to borrow Nick's investment, long-term investment thesis. I want that in that type of environment. So I actually think, to Nick's point, and I share this view, that venture, if you really want risk, when this trend changes, when leading indicators start moving up, when you've already had financial conditions improve, when you start to get liquidity trends changing, and I don't know when that's going to happen, but I'll tell you, 20 months negative for conference board leading indicators is near a record. I think the record's like 23. So we're getting quote unquote long in the tooth in this growth slowing environment. I'm not only betting on a catch up, I want to start betting on these long-term plays. I think venture capital vintages started in 2023, 2024. Man, they're going to crush it. Like when I was speaking at an alts conference in Miami 2 months ago, maybe. Guess who the belle of the ball was? Wasn't venture. Private credit. It was private credit. Like that, the amount of assets raised in private credit. And I'm not picking on private credit. I'm just saying that's not exactly where I want to be if I'm betting on an economic recovery globally and a liquidity trend changing to more positive, accommodative, wind in your sails type of liquidity. I want the thing that is hated the most right now. And I think that's long duration plays like venture. And so I'm really excited about it long term.
Okay. So Nick, then if this the kind of trend is starting to change, right? And we'll see the snapback. Do you think this is going to happen fast? Will there be this like massive acceleration back up to like the public markets, like a NASDAQ? Is it going to recover fast, or is it going to, kind of take its time and get there over time? What you got?
So I'm going to hit on two pieces there. Everything that Clint is hitting on the credit, absolutely. That is exactly what's going on. And I think how we found ourselves here, and then I'll come back to the next piece. How we found ourselves here was a lot of these companies were so reluctant to take these down rounds. And then capital was drying up. And then eventually they were going to take those down rounds, but then they started getting more convoluted, more structured. The cap table got a little bit messier, to go back to the first part of this podcast. And now you've got these weird structured entities of how the next round was reincarnated. And then maybe it wasn't any equity component whatsoever, and we started to get more to the private credit realm. And that's why private credit's going to be so freaking hot. And that's going to continue to be hot, because any of the beleaguered companies, or even just solid companies that want to really be resolute and get those equities to come back, have to make good now on the debt component of their business before they can start to see their pref come back. and then they got to get the pref to come back to actually pay the common holders, and then only then are they going to look shipshape to go public and IPO. So I actually think the IPO markets are going to be stalled despite everybody's excitement that it's going to be hot initially. It's probably going to be until second half of the year. But then also, I think that we're all a fair bit more optimistic than is going to play out. So the snapback, in speaking with a lot of the brokers that we're constantly on the line with, they have that expectation it's going to snap back. And the data that we're already printing for last month, coming into this month, is just a little bit a more subdued version of what they're suggesting will happen. So I think it's going to arc up, and when it does, the equity players I think are going to well outperform the credit shops. But for the time being, credit's like everybody's darling right now. Everybody's focused on it. Yeah, for good reason. Okay. I fair enough. But yeah, long duration. I'm gonna stick with the equity component, and just make sure. But the equity investors. Sorry, I'm just gonna ramble now. The equity investors have to be so have their wits about them in a much better way to now have to understand what's happening on the debt side of the equation, and that hasn't really been the case historically as much.
That's true.
Right?
Fair point.
Because now they're going to have to look at a lot of other aspects of how they're going to get that money back and how that waterfall is going to shape up. So
well, we still haven't had market
so
clearing.
Interconnected.
We still haven't had market clearing prices either, right, Nick? So like, I mean, it is going to be interesting. Like some of these companies came out and did rounds or did tenders or something like a Stripe, right? Where they were up at 100 billion and they came in and they did something at 50. And that was kind of, I think that's like a market clearing type price, right? For that company. But most companies haven't done that yet.
Correct.
Right? You know, like the secondaries are down, like we just talked about this past year, like Flexport's down 60%. They haven't done a primary round or a tender or anything. So it's going to be interesting to see what these guys, Plaid down 53%, Chime's down 50%. Like these guys have to have some kind of market clearing event because I don't think they're going to get back up to their old valuations, right? So
And behind the scenes, you want to know what's going to what's been happening since then. So secondary is one answer, and that's to tout our own data. But actually, where the debt, like how much debt does Equipment Share now have, or how much debt does Redwood Materials now have? If you're not able to see it or gain access to the data to show, how are you able to figure out what that market clearing price would be? Yeah. Because if you have an access point and you can get into a name or exit a name, you got to factor
this
it all
is
in.
Interesting. So I got into it with somebody on that point, right? Because they were saying like, well, how do you know what the valuation was? Like, well, I'm like, call me crazy, but it trades. So if a trade happens, that's the price. But you don't know what the data, you don't know what the debt is. And I'm like, okay, but like if people are buying and selling, it is what it is. Like, I don't think anyone goes to the public markets and says, well, that company's got a lot of debt, but so the company's worth less than what the last price on the New York Stock Exchange traded at, right?
Yeah, but you could argue both sides of that really, really well, right? Because how active are the animal spirits in this market? Do people act on full information or a lack of information and what the upside? Because I think when we're looking at a firm like OpenAI, maybe I don't care. I don't care what their debt is. They're going to change the freaking world, right?
Fair point.
And same thing with a SpaceX, and same with a lot of these companies that you are addressing because of the potential upside. You can neglect or just discount so heavily the debt component because it's not going to be debilitating to their long-term vision.
Yeah.
So I can go both ways, but if you're looking at like a company that's just cash flowing and steady growth, you got to take that into account, right?
Yeah.
You know, or more traditional, some of like the HR tech businesses that we like to look at. Those, I would say I would like to know how much debt's on the book.
Fair point.
But if someone's doing alchemy,
yeah, it'd be interesting. Well, I mean, look, if they end up doing a second round, I think that almost takes care of that piece too, right? Right, Nick? Because
it should really help for sure.
I'd have to imagine whoever's coming in and making that investment is going to be valuing the company appropriately, including the debt, right? So it's going to be interesting to see how this shapes out. Okay, real quick, and then we'll hit this last topic, but just total valuation. So like you look at this, we got ByteDance, SpaceX, OpenAI, Stripe, Databricks, Anthropic, Canva are kind of the top companies. The one thing I'll hit on is that what's so interesting to me, right, is kind of where these implied current valuations are based on the last primary round and secondary market trading since that point. I mean, ByteDance is down at 193 billion, but they're doing a buyback right now. So we'll see if this actually closes at $268 billion, right? It's at 193 billion right now, implied valuation. SpaceX is at 174. They're doing a tender at 180. OpenAI is at 72. They're out doing a primary round at 100 right now, right? And Canva is is right on it. So they're at 25.4 and they're at 26. So that one looks to be good. But you're starting to see this trend where companies are doing a tender every 6 months, right? Or Canva in this case has done something every year now. Right. So there's this like consistent cadence that's coming back. I think that's good for secondary markets, right? Because you get this like institutional pricing and price discovery, right? So Clint, like, I mean, that's got to make you more comfortable as an allocator, knowing that a big trade's gone off, right? Every 6 months or every year. And like, this is the price as opposed to something that sat out there for a year or two, right?
Something you said earlier, right? And I agree with, and I was looking it up while you were saying, because I can't remember who said it. I want to always attribute it to Paul Tudor Jones, but I don't think I'm right in this one. But someone said the best indicator is price, or the best three indicators are price, price, and price, right? So like, I mean, ultimately, I'm going to put my, if you think about what the CM Charter Market Technician designation is all about, right? It's market, technicals are all about the study of price, because that's, assumingly the sum total of all data in the marketplace. And so for me, price is truth. Price is the present reality. That's what we have, right? And I'm not saying other fundamental data points aren't important, but the most important to me is price. And so, having these rounds, having data and arm's length transactions, and being able to see where the market's pricing that gives me the truth. And to think about this catch up, going back to that conversation, and this outperformance or potential outperformance by private markets going forward, or private stocks going forward, you think about the winners really winning big. I could see momentum really taking off here, right? Especially these companies that have had more rounds, right? Not necessarily the companies that have waited. So that might work out some of the debt things itself, right? If companies are able to go to market and secondaries and get secondaries, or go to the primary rounds like a SpaceX and do this regularly, or go and get tenders, whatever, if they're able to do that successfully without having to go to the debt markets, and they're able to access liquidity in a very difficult liquidity environment, that points a lot to the strength of demand out there. And if it points to the strength of demand, then that makes me happy when I have price data and I can maybe get access. So I think there's a big case on the short run of not, if you're an investor in this space, and I'm just going to give you an opinion here, of not being a quote unquote bottom feeder, right? I would focus more on those names that are regularly transacting, that are at the top 10, that are showing positive performance. To me, that momentum means a lot. That means they probably haven't had to go access the debt markets. I'm not going to say any specific names, but I know of a company that wanted to go IPO last year, huge name, big provider, take on a tremendous amount of debt. Amount of debt when they couldn't go IPO, because they continued to have to buy other firms, right? Their model is an acquisition model. That's problematic, to Nick's earlier point. So I think that buying these winners here makes a lot of sense. And I think those winners show that truth of price because they're transacting. They're doing these things on a regular cadence, to your point, Aaron.
Yeah.
So that's where I'm at.
Okay. How about that? Let's hit on this. So we've already talked. This last thing I want to talk about 2024 going forward, which we've already kind of started to talk about a little bit, right? In this, but how about this? I won't ask you guys kind of point blank, or maybe I will, right? Any companies that you got your eye on? You don't want to do it. Okay, fine. How about this? How about let's do this? Do it. All right. So any particular company you got your eye on? Like, who do you think is going to be the big winner? Is it an AI shop? Is it a SpaceX? Like that. To your point around momentum, right, Clint? Like maybe you can go first for us. Like what do you think? Who's going to be a standout this year in 24?
I think Starlink, man. I think it's right to go public. I think SpaceX is a big winner this year. I think some of these other names in AI, other than, not to pick on OpenAI, but other than OpenAI, more the picks and shovels, the Hugging Faces of the world, I like those as well.
Databricks,
but if you said who's the one that you like the most right now, it would definitely be SpaceX with a with a spinoff of Starlink to go public.
Yeah.
It makes a ton of sense. They're just making so much headway there.
Yeah. 10 billion in revenue they're forecasting,
I
right,
mean,
for
it's
Starlink.
nutty.
It's crazy.
Nutty. I mean, I think Starlink's $1 trillion company long term, so it just makes so much sense for them.
Right.
And they're perfectly conducive. They're ripe to go public. And then again, like, I still like AI. I think AI, we're going to continue to make leaps in AI, and I think it's going to happen exponentially fast. And I want to be in the big plays, right? Not necessarily OpenAI, where it's although they're doing wonderful things. I'm not discounting OpenAI, but I like some of the other spaces that aren't like in the don't have the bright lights around the name, right? I think there's some. I think Databricks, Hugging Face, Anthropic, even though they've had amazing success, I think a lot of those names make a lot of sense long term as well.
Yeah, right. Nick, what are you thinking, man? What do you like in 24?
Well, given Clint spat out 4 big ones, I think I'm going to just leave him with saying SpaceX, which I'm not going to disagree with. But no, I would hop on the Anthropic bandwagon here because they're really valued so much lower than OpenAI,
right?
But could serve the market as more of a free agent and are kind of able to repair some of the mistakes that OpenAI have done along the way and are not clouded with kind of everything that's happening in and around their board and all the other news that kind of we're getting hung up on. And I also think that certain aspects of OpenAI's business are going to have to be rolled back or have been rolled back already. If anyone could comment down below if they've seen that, but I think Anthropic is ripe to come up off the back of that and just perform extremely well on a relative basis in terms of their valuation. So
right,
like that.
Well, the value
definitely
that
like
relative basis.
Well, but yeah.
The
ahead.
relative basis is interesting for OpenAI versus Anthropic. I mean, OpenAI at 100 billion versus Anthropic at 17, 18, right? This Menlo Ventures round that they're doing right now is a much different entry point, into something that, to your point, Nick, could arguably have a very similar kind of, kind of income statement revenue profile in the very near future. So that is attractive.
I'm basing this off of percent return, not valuation. Right?
No, which is what matters. That's what matters, right? So, okay. Any thoughts on like IPOs?
No, Aaron, what about you, man? So if you can't do Anthropic and you can't do SpaceX, where are you throwing it?
Yeah. So look, AI is going to be the big winner. It's SpaceX and AI. I mean, I know you said I couldn't say that, Nick, but I mean, it is what it is, right? Like, if you think about, yeah, I mean, if you think about what else is out there, I think, AI is the darling. Everybody's been, just like everybody wasn't an internet company and then became an internet company. And then everybody wasn't a mobile company and now they're all mobile and apps, right? It's the same thing's going to happen. Like everybody's going to be an AI company. Everybody's going to have AI. So any company in and around the spaces, I think, is going to be a big winner. I think it's super interesting that the big 800-pound gorilla tech shops are having a hard time competing with the startups. So that's like a tip of the cap to innovation in America, right? That these small companies can still outmaneuver the big ones and capitalize and take and kind of win market share. So I think that's
profoundly impact the valuations of the big ones.
100%.
Right? You can no longer
100%.
value Microsoft without taking into account what OpenAI is going to do.
100%. So I think AI is going to be the big winner. I mean, I can't imagine like fintech having similar gains as AI related companies. I can't imagine gaming or blockchain having similar returns. Like, I think they're interesting return profiles, and maybe over the long run, some of those could be cool, but just for this next year, I think it's AI, right? If you want to talk about it, I think it's AI, kind of AI or bust. So, yeah, that's where I'm putting my chips, Nick. But okay, last thing real quick, like IPOs. Clint, you mentioned Starlink. Anybody else you think that might go this year?
I'm sure there'll be a couple others that will go. But Starlink's my favorite, who I think is actually unexpected, somewhat unexpected.
Right.
But I think they'll.
Well, I mean, I tell you, we got presidential election coming up, so things will get primed for that. To your point, Clint, earlier, if we can get some rate cuts going, I mean, the stock market could start to perform. Things could get positive, good momentum going. I could see like IPO market getting flush, and there's a lot of people. Stripe is big. I talked to a guy who works at Databricks the other day. He said, quote, the only thing everyone talks about all day long is going public. Right. So, like, I think they're going soon, right? Reddit's out there. They're talking
I'm
about
an AI company. I'm going public
Plaid.
as soon as I can possibly go public. Yeah.
There's some
Demands
truth to
for
that,
that.
right? There's some truth to that. So
Suck some of the
Nick,
liquidity away from
what do you
NVIDIA.
think? Yeah,
Yeah.
right. Yeah, right. What do you think, Nick? Anything?
I think we're almost in the same position as we were at the end of last year, expecting that the Instacart IPO and the Toro IPO and others were going to promote future IPOs, and the fact that they didn't do as well, everyone was like, no, you go first. You jump off first. So I don't think it's going to be they're just off huge in February and March. I think we're going to see a few trickle in, make sure somebody was successful, make sure the water's warm, and then they're going to go for it a little bit later in the year.
Right.
Maybe not have to, like I was saying before, but not Q1 as much.
Right. Well, it will be interesting to see it. They had Jason Calacanis has podcast, a great kind of venture capital podcast. He had this fellow Brad Gerstner, which is Ultimate Capital, right? And Gerstner was basically saying, like, you guys, like, companies got to go public. Like, the water's great out here. Like, come on into the public markets, right? So a lot of what you're saying, Nick, I think there's some big players out there in the marketplace that are kind of pushing for these guys to hit the public markets, But it's going to be interesting. A lot of capital bouncing around out there in the secondaries and the private markets. So you're right, man. I don't think, to your point earlier, Nick, like, I don't think folks have to go public if they don't want to. They can certainly raise the capital and get what they need to grow and get liquidity, Clint, like you were talking about, for their employees and investors through the secondary market or through these tender offers of the private market. So it's going to be interesting to see what happens with some of these companies here in the next year or two. But okay, let's end it there, fellas. Right? This has been great. First pod in the books. By the way, we are literally 1 year anniversary.
Wow.
January 5. 2024. Yeah, man.
Yeah.
I listen. I went back and looked. Our very first pod was January 5, 2023. So this is like literally almost 1 year to the day from the very first pod that we did.
Happy anniversary.
Right? Yeah. So
Exciting.
man, happy anniversary. But yeah, I got to get you guys a present. I dropped the ball on Christmas, so now I'm going to roll it into like an anniversary present for you guys, right? So I'm gonna.
We got to all get together.
I'm gonna get something nice.
Well, we're doing,
Yeah,
sushi's in the book, right? So
yeah.
good for that.
I'll fly up any day.
Clint, you're coming up here soon, right?
Yeah.
Okay, we'll get that on the books. We'll get that on the books.
Let's get on the books.
All right, fellas. I appreciate you
All
guys. Okay. You have a good one. You have a good week.